Good morning. Welcome to Trading Hour. It's a much better Tuesday morning as the Nifty scaled above 23,200. The Sensex is inching towards a 400-point gain. Banks are higher. The Nifty Bank almost up 700 points. And we're managing green on the screen despite the weakness seen in IT. So after many days, 4 days of a crunching blow, particularly yesterday's big rout, markets have bounced back today.
Absolutely. Markets have bounced back today, and the bounce back is also coming in the broader markets, right? We're seeing the Nifty mid and the small cap also managing to hold on to good gains. You can see it on the screen above us as well. So yes, good gains at what we're seeing coming in for the benchmark indices as well as in terms of the broader markets. Now, in terms of some of these individual moves that we should see in terms of sector-wise, we're seeing Nifty Metal, that's managing to hold on to very strong gains. Among the top sectoral gainer, PSU Banks also managing to see a good up move in trade today, 3% uptick there as well. And energy media among the top gainers along with auto. Now, what's not doing well, like Rima was mentioning, we had seen Nifty IT that's under pressure as well. HCL Tech that reported the numbers. So Rima will take us through what was there in terms of numbers, but HCL Tech under pressure today, and that's also causing a bit of a subduedness for the market. And FMCG, that's the one, Rima, that is also in the red today. But IT is the name of the game today. Everything is on that.
Indeed. So HCL Tech steals the spotlight. This is the biggest single-day fall that we've seen in HCL Tech in the last 10 years. And the reason is it went into its earnings with a lot of optimism and strength. Look at the investor positioning in HCL Tech going into numbers. Last year, HCL Tech was up 30%, outperforming the Nifty IT index, which was up 23%, and outperformed larger peers like TCS. HCL Tech's PE re-rated by 20% despite marginal EPS downgrades. And by the end of it, EPS was trading at a premium to Infi and TCS at about 27-28 times. So it went into the earnings with a lot of optimism, and the numbers failed to excite. In fact, on the top line, there was a little bit of a miss. The company's revenue growth of 3.8%, missed street expectations of 4.1%. So a bit subdued there. Margins expanded to 19.5%, but in line with expectations. Again, no beat coming through there. Even if you look at the company's guidance, there is some disappointment that the company didn't raise the middle or upper end of the guided band. All they did is raise the lower end, which means the implied guidance for Q4 revenue guidance is minus 1.3 to 0.6%. Again, it's not that growth is rebounding, and even margins in Q4 will be slightly lower than margins in Q3, and the company has lesser exposure to BFSI versus peers, which is where we've seen the maximum recovery in discretionary spending. All these are factors, right? Given the positioning, there was nothing in the numbers to excite the street. Kotak says the stock trades at full valuations. They've lowered their revenue growth forecast by 1 to 4%. They've got a reduced rating on the stock, but other brokerages like CLSA, Morgan Stanley are also, they all have an equal weight kind of a rating. Nomura is the one with a buy rating with a target price of 2,000 rupees. In fact, I had a chat with the management of HCL Tech and asked them that why didn't they go ahead and raise the upper end of the company's revenue guidance or the middle end, what they expect for Q4 and margins. Listen into what they had to say.
I think our momentum across all the verticals is continuing to pick up, and there will be some impact because of a large program coming to an end in the retail CPG segment, where we had a 14% sequential growth last quarter. Now, to backfill that project with new projects, it will take some time because some of the deal wins have happened towards the end of the December quarter. So that pickup will happen towards the second half of the March quarter, and that will continue into the Q1 of next year. I think the way you should interpret this is, every vertical has some dynamics that plays into every quarter, but is the new additions adequate enough to kind of offset some of those reductions is what we should see. We are quite positive of an all-round growth in Q4.
Impact is going to be somewhere between 50 to 60 basis point. Yes, the margins in next quarter are going to be slightly lower than Q3 because Q3 has an impact of seasonality of the software. That's the only variation I can see. Otherwise, rest I think it should be fine.
Okay, let's invite Sandeep Agarwal, fund manager, Sovilo investment managers on the show. Sandeep, numbers were not exciting, but a 10% fall in the stock price, is that a bit excessive? How would you read the reaction?
Good morning and thanks for this opportunity. As you know that, markets always discount the future, and if, as you rightly mentioned, the future looks little weak for HCL Tech because one large program is coming to an end and the implied guidance implies negative. And let me tell you, this when these large programs come down, it doesn't impact only 1 quarter, sometimes even 2 quarters. And on top of that, this stock has massively outperformed in last few months. And not only this, even many tech stocks have outperformed in a very big way. So this was bound to happen. We have been saying on every media interaction in last 2 months that all positives which can happen in the sector are priced in, but whatever negative can happen, that is not at all priced in. So I think still that, except for ER&D, which could be a structural play, and you may see time correction even there for 2 years, all other IT services companies are very expensive right now, particularly because this is a matured sector where more than 7-8% growth on a structural basis is difficult. And with some margin improvement, you can see 11-12% kind of PAT growth, also aided by buyback of shares. So it is a very stable structural sector where PEG ratios could be high, what you assign, but then beyond a point, this sector is not a very high growth sector. You can assign very high multiples. So always priced to perfection.
So you're saying the IT services companies, large cap especially, are priced to perfection, valuations are rich, and growth for these companies will be in mid to high single digits, not a double digit kind of a growth?
See, the smaller companies can have double digit growth, low double digit or mid teens kind of growth, but the large companies on a long term basis cannot have more than mid to high single digit growth. There will be, and it is very simple sector because the budgets are decided globally, everything is on there, so there is nothing to even much analyze. So for example, during COVID, what happened? 1 year there was no growth because of whatever happened, and then next year there was double the growth, so it covered the previous growth also, and people started extrapolating on that growth. So I think that is a challenge. So this sector structurally is a 6-7% global IT outsourcing growth. We gain some market share, we do 8-9, and our companies can do 1% more. So it cannot be more than that growth, and some improvement on utilization, some metrics, refinement, some operating efficiencies, you can do see 12-13%. But more than that, PAT growth is not possible. And for that, you should not breach 25-30 times multiple at all, even if they distribute a lot of cash. So whenever that happens, then the stocks come down. And whenever the multiples go below 18 times, 1 year forward, the stocks recover very sharply in a short span of time.
Okay, Sandeep, what's the expectation specifically in mid-cap ITs? Where do you think the outperformance will come in from?
See, in mid-cap, the advantage is that, they don't have a backlog of a very huge base. So for them, every small deal or a small deal can make a big difference. And within the mid-cap, there are two kinds of players. One is ER&D, where, growth will be 2.5 times of IT services growth for next 10 years. So where, you can assign a very high multiple of 35-40 times also. And in 2 years, you will see that multiple becomes reasonable. So you have to invest at right time. There is another sector, which is IT services within the mid cap, where growth will be better than the large cap. So they can do 13, 14, 15% growth and maybe PAT growth of 18, 20% because there are a lot of inefficiencies which could be covered. But there again, if the PE multiple is more than 35 times, it is very difficult to justify. So I will suggest that, we have to be very cautious of valuation in this sector. That is the only thing which keeps volatility in the stocks. Otherwise, this is a very straightforward sector. Everything is reported. You can make out everything. The only asset in this industry is manpower. So if you track the attrition right, I think you don't need any advice also. It is so simple. The attrition is always a precursor to what is going to happen. For example, in this quarter, I am seeing some trend of attrition going up. That means growth will be good again in next 3-4 quarters. But at the same time, the stocks have moved up much faster than that. So price correction or some correction because of valuation could be there. Revenue numbers will not disappoint next 3-4 quarters, and margins will also not disappoint.
So what's the appropriate valuation? You're saying valuations are expensive right now, given the kind of growth, the mature growth we expect from the IT companies. So what would be the right valuation to ascribe to see a TCS, Infy, HCL Tech?
So between 20 times to 30 times 1 year forward is, I think, a right valuation, depending on the company, depending on their cash distribution. And for the mid cap, which are growing faster, again, similar multiple 20 to 30 times range. And for ER&D, you can go up to 35 times because that industry will do much better than the IT services in long run. So
but
that is the
But HCL Tech has now gotten a bit derated after today's fall. So is it attractive now, or does it need to fall a little bit more before valuations are comfortable?
So, Rima, I will give you one data. HCL Tech, and I am no more an analyst, so pardon me, and I run a PMS, so I can't speak on a particular stock. But let me tell you, it is one of the best performing stock in last decade. If you see the data, they have given phenomenal returns. So these are good opportunities. I am not saying 1800 is a good opportunity or not, but in long run, these companies are decent. They will give you returns. So you have to buy right at the right price. So if you buy them at a very expensive valuation, then obviously you will go through the pain.
But IT is also seen as a bit of a macro trade. Defensive when domestic earnings are slowing down. There is the rupee tailwind. So how do you marry high valuations, moderate growth with this macro trade?
So, Rima, the challenge is that, we always give a lot of credit to rupee depreciation. But if you see, practically all the companies are hedged, right? So you don't get, and we have done this analysis a lot in the past. The benefit of rupee depreciation is very minuscule to the actual earnings of the company. Yeah, it gives some benefit on the INR growth, which no one actually tracks. So I think that is little overhyped. And now second thing is that we are dependent on global macros. So global macros are looking okay. Let's say Trump coming in, corporate tax cut will lead to revised discretionary spend and all that. My challenge is that, everything positive what can happen is already built in the sector. But Trump being Trump, you never know how he can increase the cost of doing business, and that is not at all priced in the sector today. So I am little worried on that front. So my view is that we should always be very cognizant of what we are paying for what, and to me it looks like we are paying little too much than what we will be getting in next 12 months.
So what are you recommending to your PMS clients in IT then? Or is IT generally not a part of the portfolio?
I will not say that it is not a part of portfolio. We have very selected mid caps which are there. We do very bottom up work on that front. So whatever is reasonably priced and we see a 5-7 year opportunity, we buy those names. Right now, IT is not a blanket buy like it was last year. So last year, October, November, when most of the large companies have withdrawn their offer letter from the campus, they have postponed the bonuses, hikes. I think that was the bottom, and that is the time we were all in and very, very bullish on the IT. Now we are not in that situation.
So the overall tech exposure in your portfolio has come down? If yes, from what levels to what?
It has almost reduced by 50-60%.
50-60%. Okay. Thank you very much, Sandeep, for joining in. Sandeep, truly, like a year and a half back, he was so bullish across the board on IT, and now he's turned a bit cautious. And the tech
That's why the reduction in, I think, the 50-60% reduction from the portfolio he was holding and coverage for the IT side.
Indeed. We'll slip into a very short break on that note. We'll come back and discuss commodities. Manisha Gupta joins in on the other side.
Welcome back to Trading Hour on CNBC-TV18, and let's shift focus to what's happening in the world of commodities, where Manisha joining in with us to talk to us about the focus coming in on the metal space and metal commodities specifically.
Good day for metals, even as the dollar index is trading very close to its 2-year highs. We are looking at the US Fed proceeding with caution when it comes to interest rate cuts for 2025. The China economic stimulus package, the expectations of that has been supportive. So has been the fact that the December export-import numbers from China have been better than what the street was anticipating. So when you look at the copper prices, we are trading at a 2-month highs onto this one. The Chinese imports for unwrought copper and products has surged by 18% on a month-on-month basis. That has been supportive. And apart from that, the Chinese have been buying a lot of copper. So when you look at the Chinese premium, that is at $73 a ton. That was the recorded one in the first week of January itself. And then it's not just about copper. You have aluminum, which is also trading at a 4-week highs. Zinc prices are trading at a 3-week highs. Iron ore prices at a 1-week highs as well. This is because the inventories have slightly declined in last couple of weeks. But the street will watch out for the US inflation numbers, weekly jobless claims, and the retail data from US. All of that numbers is coming in this week, and that would give you further cues going forward.
Manisha, thank you very much for that. Let's introduce then a growth code, a special initiative by Grow on CNBC-TV18, where the aim is to empower investors and traders. So prominent investors and professional traders gathered at Grow's trading right event on the 9th of November to share their valuable insights and strategies. Here's a snippet of what pro trader Aditya Pachvaria, the co-founder of Fintore Capital, had to say about limiting your risks while trading. Listen in.
मेरा पर्सनल रिकमेंडेशन रहता है कि आप अपना ग्रॉस एक्सपोजर लिमिट कर दो. इन अदर वर्ड्स आप अपना लेवरेज लिमिट कर दो. इंस्टेड ऑफ आप हेज लेने के बजाय अपना लॉट साइज को आप आधा, मतलब 3,25,000 पे एक लॉट चलाओ आप, इंस्टेड ऑफ 75,000 पे एक लॉट चलाने के बजाय. और जैसे जैसे आपका लॉस आ जाए, आपका 5% लॉस हुआ तो उसके बाद आप 3,25,000 के बाद आप 2.5 लाख पे आ जाओ, आप 2 लाख पे आ जाओ, और 5% और लॉस हुआ. इस तरह से आप धीरे धीरे अपना एक्सपोजर बढ़ाते जाओ, क्योंकि अल्टीमेटली मार्केट जब ऊपर जाएगा आप इकट्ठा रिटर्न पूरा सबका निकाल दोगे उनसे भी. प्लस आपको म्यूचुअल फंड्स, एफडीआर का रिटर्न आ भी रहा है, तो आप 6% अगर एफडीज में भी इन्वेस्ट करते हो, फिर ये ऑप्शंस करते हो, तो आप अपना वैसे ही 7-8% तक का तो ड्रॉ आप ऐसे ही ले सकते हो, तो भी आप अपना साल के एंड में 0 पे ही छूटोगे.
Welcome back to Trading Hour on CNBC-TV18. Markets managing to hold on to the gain. Nifty holding on to 23,200 levels. Let's also bring on board Mitesh Thakkar, who's joining with us to give us a quick view on the markets on the technical front. Mitesh, good morning and thank you so much for joining in with us. What is the psychological mark that now the Nifty will have to hold on to continue this up move? 23,200 is what it's managing to hold on to right now. But what is it that by the end of the day, the level that we should be keeping an eye out on?
So I think the level which I'm watching closely is not one which needs to hold on to, what one which the index needs to cross above is 23,325 to about 23,350. See, in the November fall, we had a bottom over there at 23,350 was the lowest closing. And then yesterday, as we broke below it, there was a gap down. So there's a gap as well as a previous swing pivot. I think a good reversal will be signaled only when we see move beyond 23,350. Till then, it's just a mild pullback. Though I am, in the morning, I did suggest a bullish case and suggested that we might actually try and test 23,320, 350 zones. But only once we cross that, we'll be in the knowledge that at least a temporary bottom has been made.
Another 100-point upside from these levels is possible on the Nifty, but you won't play it by taking a long position in the index.
We have, Reema, good morning. We have some long positions, we've taken some bullish call spreads because, we are bouncing back from extremely oversold levels, but I intend to book it around 23,300, 320 zones and only, get into bullish positions again about 23,350.
And what about stocks?
So I think Adani Group stocks are in focus today. Adani Group, Adani Green is something which is interesting me. It made a low of around 890 in November, and then again yesterday the low was around 885, 890. So it's kind of a double bottom formation which might happen. I would recommend buying this one or slowly accumulate around 1,000 to about 985 zones. Keep a stop at 969 and look for a target of 1,060 to begin with. The other stock which I like is something which I have recommended earlier as well, Bajaj Finserv. For people who want to enter afresh, wait for the stock to clear 1715 in cash. It's about 1705, 1707 right now. So another 10 rupees higher. Buy then with a stop below 1700 and look for a 1760 kind of a target.
Okay. Mitesh, anything you specifically checked today? We have PFC, REC also. Both these are also in focus, some bit of a volume that we're seeing. So, would you be looking at this? Anything interesting here?
So, disclaimer, I own PFC in my portfolio. In fact, I bought it yesterday. So, again, the idea was that extremely oversold, fundamentally a good company. The bounce back target which I have for PFC is around 435 to begin with, 435, 440. And above that, I'll look at a bigger reversal. And REC, if you look at the charts, I think, again, a similar kind of a setup. Both the stocks, in fact, move in a very common manner. So, REC, the first target on the upside is around 490. And once you clear that, then I would look at 535, 540.
Okay, thank you very much for that. Let's get to JSW Energy. This is after it wins a bid to acquire KSK Mahanadi Power Plant. Sudarshan is here with the details.
So JSW Energy is in focus, and you can see the stock is higher, currently up more than 6%, and it has announced that company has acquired KSK Mahanadi Power under corporate insolvency resolution process, and the bid amount of the company for KSK Mahanadi was around 16,000 crore. Basically, it was 15,985 crore, and completion of this deal would be subject to regulatory approvals, and 2 approvals that would be required out of NCLT and CCI. So why is it positive for JSW Energy? First, currently KSK Mahanadi owns 3.6 gigawatt, or say 3,600 megawatt thermal power plant in Chhattisgarh, of which 1800 megawatt power plant are already operational, and second 1800 megawatt is under construction. Now, post this deal, JSW's thermal generation capacity will increase to 7.5 gigawatt, and company believes this deal will help company achieve target of 20 gigawatt total generation capacity, and that would be much before company's target of 2030. Now, apart from JSW Energy, this deal would be positive for 2 other companies, and those are PFC and REC. Why? So, PFC and REC are amongst major creditors to KSK Mahanadi Power. Now, total that KSK Mahanadi Power owed to creditors, including financial creditors, were of around 32,243 crore. That was before August. In August, company distributed the amount after NCLT order, and the distributed amount was around 6,240 crore. And after the distribution, total balance outstanding is of 26,000 crore, and of which PFC's amount is considered of rupees 3,400 crore and REC is of 2,700 crore. So investors are assuming that once the deal is completed, both PFC and REC will be getting amount from KSK Mahanadi Power's acquisition by JSW Energy, and that's the reason you can see big move in all the 3 stocks, JSW Energy, PFC and REC.
Okay. That is why we're seeing focus on all these 3 stocks, JSW Energy, PFC and REC. But Sudarshan, you're tracking one more stock, MGL, that's also in focus today, and this is on the back of a brokerage note. Tell us more on this one.
That's correct. MGL is higher today because MS has come out with a note. It has initiated coverage with an overweight call, and target is rupees 1,606 per share, implying an upside of nearly 25% from current levels. What does MS say? It says Mumbai is an ever-expanding city with rising travel and energy needs, with natural gas being Mumbai's fuel of nature. It goes on saying that it is both MGL and Mumbai's Tesla-like moment for gas adoption. Also, MGL has 5th of its gas sourcing linked to LNG, which will put pressure on margin, but volume for MGL is expected to be structurally higher going forward, and that, as per Morgan Stanley, is going to be the key for re-rating of MGL stock in coming days, and that's the reason it has initiated coverage with an overweight call.
Thank you very much for that. Let's get to United Spirits. That's in focus after the company has announced a management change. Delta Corp also on our radar. Weak Q3 numbers here. Mangalam is here with the details.
Well, if you look at United Spirits, another day where in the FMCG space there has been a surprising exit from the leadership. This time around, Hina Nagarajan has decided to step down as the MD and CEO of United Spirits from 31st March 2025, and that's largely because she will be taking on another role in Diageo itself. My sense is would be a lot more global than Indian itself. And as a result of which, the management has announced the replacement as well. And we'll have Praveen Someshwar, who is currently the MD and CEO of HT Media. He's been there for the last 5 years, who takes over with effect as MD and CEO from April 1 itself. That's the next financial year. And before HT Media, he was with PepsiCo for about 24 years. So, well, in MNCs, there are these leadership changes that happen, but typically the transition is what causes the uncertainty, and as a result of which the stock is lower in today's trading session. Mind you, the last 4 years under Hina Nagarajan's leadership were very strong for the company. The stock also rallied nearly 3.5 times in her tenure as MD and CEO. On the other hand, Delta Corp, remember the third quarter typically very strong for travelers going to Goa, for the casino and the kind of businesses that these companies are in. And the street was expecting a decent set of numbers, but the company actually went ahead and reported a 7.5% decline in their overall revenues. And that's actually led to a bigger decline in the operational performance because of operating leverage. So the stock, is lower in today's trading session after the EBITDA declined by 42% and margins compressed by over 1,000 basis points. Across both their segments, casino as well as online, there was an operational dent. In the casino business, they actually saw a revenue decline of about 3.5% as well. Remember, Delta Corp has been under pressure ever since the GST change of 28% tax on the face value of all the bets came about for, casinos and online gaming itself.
Thank you so much for that, Mangalam. Keep an eye out on both these stocks. But time for a very short break. But counting down to the budget 2025, India is looking to seize the moment and establish itself as a global economic outlier. The upcoming budget, which will be the NDA government's first full budget after the election victory, will be key to unlocking the ambitions of millions of Indians. So tell us what you want from Budget 2025 by submitting your wish list to CNBC-TV18's budget box. And tune in to your budget headquarters, CNBC-TV18, for unparalleled insights and coverage on Budget Day, this 1st of February.
Welcome back. There is a recovery underway. The mid-cap index is up more than 2%, so things are looking strong, and we managed to hold on to that, pullback. Ajit Banerji, Chief Investment Officer at Shriram Life Insurance, is now with us to talk markets and the way forward. Ajit, thank you very much for joining in. There is one view in the market that this slowdown that we're seeing, domestic slowdown, is going to be a little more prolonged, and therefore we're in for a period of weak earnings growth compared to at least consensus expectations. Now, you're penciling in a 9 to 10% earnings growth for FY25 and 11 to 12% CAGR over the next 3 years. Does that seem a little excessive, or do you expect domestic economy to bounce back in the subsequent quarters?
Okay. First of all, first things first, thanks for having me on the show. And
thank you for joining.
Wish you and your viewers a very happy Makar Sankranti. See, at this point of time, we have been used to seeing, a quantum leap as far as our GDP growth is concerned, and that was quite, I would say, supported by high amount of, government support in terms of capex as well as pent-up demand from the consumption side, both of which at this point of time are lagging a bit. Now, of course, the bigger question is government also is to what extent they would like to set its eye on setting the fiscal in order, what it has already taken a target, or go into a fiscally expansionary mode. That's something what we need to see. So, and at the same time, to add to that, how post January 20th, once Trump version 2 comes into power, how, the way things, he has been, giving one news and shockers to the world. So everybody is quite, I would say, skeptical about how things will unfold once he comes into power. So, lot many uncertainties are there. Some might turn out to be a tailwind for us, for the economy, and some might turn out to be a headwind as well. Now, since internally also, the urban consumption has slowed down a bit. So naturally, and at the same time, we are not, seeing a good amount of, tailwinds in terms of the cost, cost and the margin from the, entity's perspective. As a result of which, we expect that going forward, at least for next couple of years, there would be a bit of a, lower double-digit, growth, which is going to come in terms of the, earnings for next couple of years at least. That's what is our in-house view.
Okay, double-digit growth for the next couple of years is what you're highlighting. One point I want to also understand. Okay, you did highlight, Trump coming in and that uncertainty is there. But US rate hikes, that's also there. We're seeing a stronger dollar right now, as well as, trade policy, those continue to be the headwinds. So what is it that maybe could work out for the Indian equities? Possibly, what are the triggers that maybe we could see this growth going forward?
So, one thing which can benefit us, because we also have a good amount of export in terms of IT, pharma, as well as in the service sectors also we are doing pretty well. So I guess if the US economy recovers at the same time, I mean, if there is a expansion happening in terms of mood looks to be pretty high at this moment. So therefore, we can expect, a higher amount of order flows from the US for the, pharma in any case is doing well, as well as IT, and also India can also benefit from if the curbs what are being on and the tariffs which are being threatened at this point of time, and I'm using the word threatened because we need to see that what comes out finally. If on China and Mexico, Canada comes in, so as an alternate sourcing, partner, India might actually be benefited out of it. So far we have seen that with the earlier dispensation of Trump, as well as Indian government was pretty good. So if India can further cement the ties as well as, then we can benefit out of it. So at this point of time, engineering goods as well as IT, pharma are already at an advantageous position, which we can see at this point of time. Now we have to build up, therefore, that what are the other gaps which are there as far as manufacturing is concerned, on which on electronics also, on which the reliability on China might come down or will be possibly deliberately brought down, and there India can fill in the gap.
Sure. So IT and pharma is what you are highlighting. In IT and pharma also, would it be more mid-cap ITs or large-cap IT companies that you would look at? And pharma, would you be more towards the CDMO side? Because that's also expected to start doing well in 2025.
See, as far as the large-cap ITs are concerned, they certainly have much more diversified product range. So naturally, they have a larger offerings, so as to say. But at the same time, mid-caps also have an advantage for they are specializing in certain, very specific activities, which can also give them a benefit as well as their cost in terms of cost benefit. Also, mid-cap companies are at an advantage position. So we would say that it cannot be so generic in terms of whether it would be large cap and mid cap. Both has its own unique advantage and disadvantage. So we have to see that depending upon what is the nature of the services required or indented by the US. So based on that, either of these can actually get benefited out of it. As far as the pharma is concerned, typically what we are seeing is that if I specifically go for the pharma sector, I think India would do well for the there are advantages in terms of the China Plus One and the Biosecure Act, which is coming into play. These are the things where India can possibly get an advantage, as well as where if we can expect that already in the generic drugs and all, because of cost advantage that India has, I think it looks quite positive at this point of time.
Right. Mr. Banerjee, a couple of sectors that you've highlighted that you're a bit cautious on, I think, is FMCG and metal sector. So, what is your word for FMCG? Do you think the subduedness that we're seeing will continue all throughout 2025, or maybe, the second half of calendar year 2025, we could start seeing a recovery?
See, as of now, what we are seeing is that, the mood is pretty subdued as far as the consumption is concerned. We have also seen that in the FMCG sector, there are certain amount of destocking also happening. The companies, when their commentaries have also mentioned that, they are not seeing much, recoveries in terms of the sales are coming. At the same time, there's a cost pressure. Plus, there is a local competition which is happening. As a result of which, the 2025, at least the first 6 months, is certainly going to be a pain, especially in the urban side, while rural recovery seems to be happening. But thereafter, once we get to see that overall we are expecting that the government also has through its budget as well as other measures has left more disposable income in the hands of the in the consumers. At the same time, the economic offtake also has happening. Then the mood will turn positive, and thereafter so H2 onwards we can see a bit of a recovery in the FMCG sectors is what our views are.
Okay, Mr. Banerjee, thank you so much for joining in with us, giving us your views on the global as well as the domestic market and talking to us about specific sectors that will be in focus as well. So thank you so much for joining in with us. But on that note, we're going to slip into a very short break. But after the break, we'll tell you what the banking sector can expect in Q3 FY25. So don't go anywhere.
Welcome back. Let's get you some opinion now. Earlier today, we had a chat with Surendra Goyal and Samiran Chakraborty of Citi to know more about the slowdown in the Indian economy, the state of the market and the weakening rupee. Listen in to what they had to say.
Market upside perspective, we are seeing around, say, 12-13% upside from current levels. That's what our December target for this year is. There have been a bunch of things which have resulted in slowdown in earnings. Right, you look at it sector by sector, there are various reasons. You have seen it in banking, you have seen it in consumption. And I think some of it are driven by more temporary issues. And I think as those things resolve, right, and mention kind of some of the policy measures which will really help there. I think as those issues resolve, we should come back to more the kind of growth rate that we typically get on earnings in India.
While the government has committed on the 4.5% fiscal deficit number for FY26, and we think that commitment will be kept, if for the next 3-4 months we see the capital expenditure pick up to meet the budgeted amount, then that itself could act like a mini stimulus. So to that extent, the bulk of the policy side intervention will have to come from monetary over the medium term, but in the short term, the fiscal can also help. That would probably make the urban consumer recovery. And we are quite confident that the rural drivers are still strong. And that's why probably we get up to about 6.5%, 6.6% GDP growth for next year is what our forecast is right now. We have still our baseline as the February to be the starting point for the rate cut. We think that the inflation numbers are moderating quite nicely. Yesterday's print has been slightly below expectations. January print is probably going to be below 5, maybe something around 4.7. And in second half of the year, we should see inflation trending closer towards the 4% medium-term target that RBI has. So that opens up space for some easing. And also we'll have to see to what extent RBI is taking the liquidity easing measures, which are very much required right now, because that will act as a signal for rate easing in February.
Okay, let's move on. It's time for a special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, Abhishek will tell us how Q3 FY25 will be for the banking sector. Over to you, Abhishek.
To begin with, deposit growth on a year-on-year basis was at 9.9% at the end of Q3 FY25 and about 2.6% on a sequential basis. So YOY, the deposit growth is the lowest that you are seeing since March of 2023 as per RBI data. Advances growth was about 11.2% YOY and 3.6% sequentially. So loan growth has outpaced the deposit growth this time around as RBI has brought down the cash reserve ratio requirement for the banking sector in the previous MPC meeting. Hence, you saw the loan growth outpacing deposit growth this time by the end of Q3 FY25. Now, credit deposit ratio for the industry is at all-time high of about 80.5%, reflecting a more aggressive lending stance by the banking sector. Now, this augurs well in a high interest rate scenario for some lenders to maintain their net interest margin at healthy levels if at all they are able to curtail or contain their slippages. Now, net interest margin is expected to remain largely unaffected for most of the large lenders. We may see marginal decline for some of the lenders who have been aggressive on deposit growth, and net interest margin will also get impacted for lenders with higher slippages in Q3 FY25. Now, the net interest income growth over here is expected to be sluggish, particularly for PSU banks. So PSU banks have largely raised deposit rates at high cost while their loan growth is lower than the industry levels. On credit costs, certain sectors, especially especially those with unsecured lending like personal loans, credit card loans, as well as microfinance, they are expected to face higher credit costs in Q3 FY25. Now, this could be as a result of higher defaults and hence incrementally increased provisioning requirement for Q3 FY25. There is a need for more evidence to confirm whether these higher credit costs are stabilizing or not. Now, with respect to earnings outlook, overall earnings are expected to remain weak for the banking sector, particularly for PSU banks, because largely the treasury gains that they have had in the previous quarter will be missing this time. For some lenders, higher credit costs can impact their earnings momentum as well. Overall, earnings are expected to see weak momentum for the banking sector in Q3 FY25. Now, asset quality, while it may be generally stable for large players, concerns remain around the unsecured lending portfolios, which are expected to see continued deterioration like they did in the previous 2 quarters. X of unsecured loans, asset quality is largely expected to remain under control or see marginal improvement for the banking sector. We have some of the key estimates coming in from Kotak Securities. For SDFC Bank, they estimate NII growth of about 9% YOY, and for PAT, they estimate it to be at 16,591 crore, which is up 1% on a YOY basis. For ICICI Bank, the NII is expected to be up 9% YOY and profit is expected to be up 14% YOY. For Axis Bank, the NII is expected to grow at 10% YOY, but profit to be up only 3% YOY. For SBI, the NII is expected to be up 6% YOY and profit is expected to be up 59% YOY, but a decline of 21% nearly on a sequential basis. For Bank of Baroda, Kotak Securities estimates NII growth of 7% YOY, while profits are expected to decline by 13% on a YOY basis. Back to you.
Thank you very much for that. We will slip into a very short break. We'll come back with more on the market. Stay tuned. Welcome back. A little bit of a moderation seen, at least in the large cap space. The Nifty has dipped below the 23,200 mark. So it's some of the banking names, so an IndusInd Bank or an HDFC Bank and L&T. These are stocks where we've seen a little bit of a slip in the last 10-15 minutes. Updates coming through from Angel One. Will monitor the impact from new norms for 1-2 quarters before deciding on the price hike. True to label, impact should not be more than 2%. Keep tracking the updates that we're getting there. But it's time now to get you the latest on insurance. Sources say that parent entities of large insurers are likely to submit public listing plans with the IRDAI very soon. Yash is here with the details.
Well, Rima, this is quite unprecedented, where the regulator is seeking a roadmap from, of course, parent entities when it comes to listing, public listing of their life insurance subsidiaries. And these are large life insurance subsidiaries and their parent entities. So what we've been given to understand is that some of the large parent entities are expected to file this roadmap for a potential listing of their insurance subsidiary by January 31st, which means the end of current month. Essentially, these parent entities include HDFC Bank, Bajaj Finserv, Tata Capital, SBI, which are expected to submit the roadmap for the insurance subsidiaries. What we've been picking up from our sources is that the regulator, that is IRDAI, last week met some of the chiefs of these parent entities to discuss this potential plan for them to submit the roadmap for the public listing of their insurance subsidiaries. And hence, what has been given from the side of these parent entities to the regulator is that they will submit the plan by the end of this month. What are these parent entities expected to consider while submitting this plan? Of course, that would be in terms of the size of the insurance subsidiary. It would be in terms of certain specific business milestones that they plan to achieve before they go out and list on the exchanges, and also it could be in terms of the time that they've spent in the market itself with respect to their operations. Of course, in terms of the parent entities, HDFC Bank's unlisted insurance subsidiary is HDFC Ergo, SBI is SBI General, Bajaj Finserv has both unlisted entities, Bajaj Allianz Life Insurance and General Insurance, and Tata Capital has its unlisted insurance subsidiary in the form of Tata AIA Life Insurance.
Okay, Yash, thank you so much for giving us those details there. But, with that, we are absolutely out of time on this hour, this session of Trading Hour on CNBC TV 18. Stay tuned in for Half Prime Report up next.